In chapter 4, we learn a new way of recording our different types of business transaction using now what's known as the general journal. So you ready? Let's go. We'll first look briefly at what's known as the accounting cycle. The accounting cycle is a series of steps that takes place during the accounting period in which the companies take their everyday business transactions and turn it into useful accounting information. So we're going to look at really in this first video just the first two steps of the accounting cycle. We'll cover all 9 steps throughout the next several weeks, but for right now, we'll look at step 1, how to analyze and classify business transaction, and step 2, how to journalize those transactions. So what's a journal? A journal is what we call a diary of business activities. It is a listing of all of the business transactions that take place for a company over a specified period of time. So a journal may be for 1 month, it may be for a quarterly basis, it may be for the entire year. Now, there are different types of accounting journals. We're going to use one today known as the general journal. So our focus today is on how do I use the general journal to record my business transaction. Now, in your journal, you record each transaction in chronological or date order. Okay. First, we have to look at how do I analyze those business transactions. Analyze means to do, identify which accounts are affected by the business transaction, determine what are the account classifications, meaning is the account an asset account, a liability account, owner's equity account, etc., and then determine if the account increased or decreased. Next, we are going to apply the rules of debits and credits that we learned in our previous chapter. These rules indicate to us what side of the account will make the account increase, what side of the account will make the account decrease. Once we completed steps 1 and 2, we're now ready to what we call journalize our different types of business transactions. So let's get started. For this first transaction, it says on November the 6th, Trey and Eli, the owner, withdrew $100,000 from a personal savings account and deposited to a new business checking account for Eli's consulting services. So notice the format of the journal. First, it'll show the actual page number of the journal. Next, you have a date column, a description column, a post-reference column, a debit column, as well as a credit column. Okay, so first we record the date of each business transaction. The journal records each transaction in a chronological or date order. Next, you're going to identify which accounts will be involved in this business transaction. So for this illustration, the accounts involved would be cash, and it would be Trade and Eli capital account. Okay? Important rule. When using a journal, whatever account you're going to debit, write that account title first in your general journal for each business transaction. I'll say it again. When using the general journal, whatever account you're going to debit for each business transaction, you're going to write that account title first in the general journal. So in our example, we're going to debit the cash account because cash is increasing. Cash is an asset. Assets increase on the debit side. Record the amount in the debit column of $100,000. Then come back to your description column, put the account we're going to credit, which is Eli Capital, but notice the format. We're going to indent and then record the account that we're going to credit and record the amount in the credit column of the general journal. The last portion is a description of the transaction, which I'm not too concerned about that. I'm more concerned that you know how to record the date of the transaction, indicate which accounts are involved in the transaction, show what account we're going to debit, which one we're going to credit. Every journal entry has to balance, meaning the total amount debited must equal the total amount that we credited. Want another one? Okay. For the next transaction, on November 7th, we issued a check to purchase a computer and other equipment. So once again, first record the date of the transaction, November 7th. Determine which account we're going to debit by applying the rules of debits and credit. You'll debit the equipment account because equipment is an asset and the account is increasing. Assets increase on the debit side. You'll credit your cash account because cash is decreasing. Cash is an asset. Assets decrease on the credit side. For every business transaction, the total amount that was debited must equal the total amount that you credit. Next, November 10th, we purchased office equipment on account for $6,000. Once again, the date goes first, November the 10th. We're going to debit the equipment account to show its increase of $6,000. Credit the liability account accounts payable for $6,000 to show the increase in our liabilities. Once again, when doing the journal entries, the total amount debited must equal the total amount that was credited. Look at a few more. On November 28th, we purchased supplies for $1,500 by issuing a check. So again, you first want to determine which accounts are involved in each business transaction, what are the account classification, are the accounts increasing or decreasing, then apply the rules of debits and credits. So our date is written 11/28. Supplies is an asset and is increasing. Assets increase on the debit side. We're then going to indent and write the cash account title and record the amount of $1,500 on the credit side. Every transaction must be in balance. The total amount debited must equal the total amount that was credited. On 11/30, we made a partial payment for the office supplies that we purchased earlier. We made a partial payment in the amount of $2,500. So again, your date goes first, November 30th. You're going to debit the accounts payable account because the accounts payable account is decreasing. It is a liability account. Liability accounts decrease on the debit side. We're going to credit the cash account because cash is decreasing. Cash is an asset. Assets decrease on the credit side. And yes, every journal entry must balance. The total amount debited must equal the total amount that we credited. Okay? Next entry, we wrote a check for $8,000 to prepay, being the keyword, rent for December and January. So the date goes first. We're going to debit prepay rent, which is the asset account for $8,000. Credit the cash account for $8,000. The total amount debited equals the total amount that we credited. Perform services for $36,000 in cash. So again, the date December 31st. We'll debit the cash account $36,000 because cash is an asset and is increasing. Assets increase on the debit side. We'll credit fees income, the revenue account, because it's increasing. Revenue accounts increase on the credit side. So yes, you must know the rules of debits and credits in order to use the general journal to record your different types of business transactions. Next, we perform services, this time on account for $11,000. So you must understand what on account means. They mean they haven't paid us yet. They owe us money. So the account receivable account, an asset, will debit for 11,000 to show the amount of money is owed to the actual business. Credit the revenue account fees income for $11,000. Receive 6,000 cash from a credit client on account. Analyze it. This is saying that a client that owes us money, they're now paying us $6,000. Therefore, the cash account will increase by 6,000, shown on the debit side. Account receivable is going to decrease by 6,000, shown on the credit side. Okay. Then we pay 8,000 for salaries. So with debit salary expense, 8,000, credit our cash account. And for the last transaction, the owner withdrew 5,000 from the company for personal expense. Debit the owner's joint account for 5,000. Credit the cash account for 5,000. So once again, we're still applying the rules of debits and credits in order to show the increase or decrease to the appropriate account. Compound journal entries. Compound means that for this type of transaction, you're going to have more than one account shown on the debit side, and or you're going to have more than one account shown on the credit side. However, the total amount debited must still equal the total amount that was credited. For example, on 11/7, a firm purchased equipment for $5,000, issued a check for $2,500, and agreed to pay the balance in 30 days. So you have to ask yourself which accounts are involved in this business transaction. I give you a hint. There are three accounts involved in this transaction. It involves the equipment account, it involves the cash account, and it also involves the accounts payable account. So to record this transaction, the date goes first, 11/7. You're first going to ask yourself which account or account are we going to debit. We're going to debit the equipment account, in this case for $5,000. The account you're going to debit always goes first in the general journal. We have two accounts on the credit side, both cash and accounts payable. We're going to credit each of those for $2,500. Now, it doesn't matter if you put cash first or accounts payable first because they're both showing up on the credit side. But notice that we're going to indent and then list the two accounts that we're going to credit. Now, the key is this. You have one account on the debit side. You have two accounts on the credit side. However, the total amount debited is $5,000. The total amount credit is going to be $5,000 as well. So regardless of how many accounts you have on the debit side or the credit side, the total amount debited must always equal the total amount you're going to credit. So be sure to review this video on how to use the journal to record your business transaction. We're going to have a second journal that talks about how to take data from the journal and post to what's known as the general ledger.